Yes, your boy Crypto Blood, and welcome to another episode of My 2 Cents. This morning we're looking at the Fed. There's a new rule they're proposing. You won't believe this. They want to let inflation run hot, quote unquote hot, people, ahead of the next recession. We're going to take a look at this out of Zero Hedge. And also something that a trader over at NorthmanTrader.com wrote on Zero Hedge, proposing a question. Is the game over? Is game over with this whole monetary alchemy we've been doing really since 1971? And, you know, some can argue even earlier than that. But for sure, since 2008, is the game over? We'll take a look at this article, also out of Zero Hedge today. But before we start, if you guys find these types of videos informative, make sure you like, share, and subscribe, and click that bell to receive more videos like this. And now that we got all that out the way, let's take a look at this one I did not mention at the beginning of the video, but it also caught my attention. I had this pinned as well this morning. 47% of GDP. That's what this article is saying, and the statistics say out here. As far as a corporate debt bubble in the U.S., this is a major thing. When I saw this, I really think that corporate debt is something that many aren't paying attention to. It's not sexy. You know, most consumers have no clue about it, and corporate debt is at an all-time high. Cheap money. And, you know, this is what happens when you create environments for cheap money. You get bubbles in unintended areas and unintended consequences for that. So it says, thanks to exceedingly low interest rates over the last decade, U.S. corporations have been able to go on the greatest corporate debt binge in history. It has been a tremendous boom, but it has also set the stage for a tremendous bust. Large corporations all over the country are now really struggling to deal with their colossal debt burdens, and defaults on the riskiest classes of corporate debt are on pace to hit their highest level since 2008. Everyone can see that a major corporate debt disaster is looming, but nobody seems to know how to stop it. Everyone except the common folks, right? The people not on Wall Street. We always are the last to get the phone call, the last to get an invitation to the party. At this point, it says the companies listed on our stock exchange have accumulated a total of almost $10 trillion in debt. I'm going to say that again. $10 trillion in debt. That is equivalent to approximately 47% of U.S. GDP. It says a decade of historically low interest rates has allowed companies to sell record amounts of bonds to investors, sending total U.S. corporate debt to nearly $10 trillion, or a record of 47% of the overall economy. So in recent weeks, the Federal Reserve and International Monetary Fund and major institutional investors such as BlackRock and American funds all have sounded the alarm about the mounting corporate obligations. So I just want you to let this chart soak in for a second, people. Can you believe this? Look at this. 80s boom and 90s oil shock recession. We had levels at 43%, and then we crashed. Dot-com bubble, we got up to about 45%, and we crashed. Housing bubble, our recent financial crisis, got just about the same level as prior, 45% roughly, and then crashed. We are now even higher than those two previous financial crisis. It can't end in a positive light. It just can't. Corporate debt is up a whopping 52% since 2008, and this bubble is continually growing. And actually, the $10 trillion figure is the most conservative number out there, because if you add in all other forms of corporate debt, the grand total comes to about $15 trillion, and that stat comes out of Forbes. So if you use Forbes number, then GDP, corporate debt to GDP, is actually at 74% of U.S. GDP. So needless to say, this mountain of corporate debt is definitely unsustainable. And that's the thing about Trump. I understand what he's talking about out there, touting that we're in the best economy that this country has seen. I understand all those talking points, and a lot of that is just, he's a businessman, so he knows how to posture and really sell his brand and what he's doing. Now, granted, things have been very well under his administration, no doubt about it. But what I think he's not wanting to admit publicly is the fact that there are things underneath this economy that are just a ticking time bomb. Okay, and so this is one of them, corporate debt. This is one issue, and this is actually, I'm gonna be honest with you, I was talking to someone on Twitter yesterday about this. He's like, CB, how can you support Trump and you say things are doing well under his administration and think it's okay for him to say that, I said, what else is he supposed to do? Why? Of course, he's going to want to keep those interest rates low. No, it does not help middle class at all. But it's a lose-lose. If he allows interest rates to go up, which he's a businessman, that's not something, he loves cheap money. That's how he's made billions of dollars off of cheap money. But let's just say he's like, okay, I'm going to be the one to be fiscally and monetarily responsible for once. If he does that, it ruins his whole campaign. He can't run on a crashed stock market. He can't run on unemployment skyrocketing, us rolling back into a recession, which we're going to do anyway. But still, he can't run on that, right? So who in whose right mind would trigger that purposefully? No one. So he's just trying to can kick like every other politician, every other president. He doesn't want it to be his issue. All at the same time, trying to bring some order, some rebalance to this world economy, because China's been just screwing us. We've been allowing them to screw us for 30, 40 years now. So I understand. You got to look at things in context. Like Trump's policy, as far as basically bullying the Federal Reserve to keep interest rates low, does nothing for middle class America. Absolutely not. But again, why would he want to increase interest rates and do the savers a favor just to have the savers not have a job, because it all falls apart if interest rates go up? That's including, what we have with the corporate bond situation. They can't handle higher interest rates. It's already on the brink. So it's a lose-lose for all of us, not just Trump. What Trump has is an amalgamation of years of horrible can kicking, borrowing from the future. So it's not Trump's fault. He's got to play the game, just like Obama had to play the game. So we'll see how things pan out in his second term. If he gets a second term, I personally think he's going to get a second term. I heard him on the Bill O'Reilly interview when O'Reilly asked him, would you try to lower the debt in your next term if you were elected? He said, yeah, it'd be easy. So we'll see about that, Mr. Trump. I don't think it'll be easy at all, because unfortunately, the people don't know what's going on. They see a stock market crashing. They see unemployment, rising. They see government programs being cut. That translates into something you're doing wrong, Mr. President. And so it's a catch-22 for all of these presidents for the most part. But I will say I really do appreciate him attempting to. I don't think it's really going to do anything, or it may even make things worse. But at least someone is attempting to bring back order to what China's been doing to us for so many years. So we'll see. Just wanted to read that one, though. 47% of GDP. If we don't take the numbers from Forbes. Forbes says it's 75% of GDP. It's crazy. So it's game over. Definitely. Maybe the game is over, people. And there's nothing we can do about it. So this one is also out of Zero Hedge. And again, it just talks about Mr. Henrich from NorthmanTrader.com talks about, what happens essentially when you toss 97.9, just go ahead and say $98 billion of liquidity at an extended market, and it sells off anyway. Maybe nothing, but maybe everything. And look, the markets are trying so hard to stay inside of a wedge that we're at the end of. Can't go any further. What are we going to do here? What are we going to do here? So today the S&P futures hit 3157, or 1.7% above that level he outlined at that point. Back then I discussed an apex of trend lines possibly converging in October of 2019. However, October came and went, and the Fed went full repo and QE, and markets kept ascending relentlessly until today. And guess what? Despite all the rallying, S&P futures still hasn't managed to recoup or capture its broken 2009 trend line. It still hasn't overcome its 2007 trend line either. And it still hasn't overcome its broken trend of 2019. So no, sir. What this rally has done to run relentlessly towards a trifecta apex of trend lines this morning in pre-markets, as we see, got in within 20 to 25 handles of the apex peak point and on a negative monthly divergence again. So now there's nothing that says we can't get above it with all this liquidity. But I note that the S&P futures got near the apex and suddenly rejected, even with 97.9 billion in liquidity thrown at it. This convergence, he says, of trend lines ends this month. It may simply mean nothing, by the end of the month, or it may mean everything. It's simply too early to tell. If it means everything, then it may be game over for this bull run. So then he goes on to talk about this megaphone structure still intact, still bumping up against the top range of this. I don't trade equities anymore, people. I primarily just stick to cryptos and FX, because here's the thing with this whole equities game. Because here's the thing, people. We can go on and on with this thing. I mean, defy gravity. I mean, if 97 billion isn't enough, why not 1.5 trillion? Like, it will just continue to go on. There's going to have to be something that money can't fix. And maybe it's the corporate bonds. We don't know. We don't know. We just have to be prepared. So yesterday, the Dow Jones did slam down pretty hard, down 1%. But in the grand scheme of things, very close to all-time highs. If we break this area right here of 2778, 27,784 region, then I would be kind of concerned, and we're kind of right there right now, right at that critical support area. So if we break that, then we could see a move back down to possibly 27,218, which in the grand scheme of things, it isn't much, people. This little dip here was, of course, you guys remember when Powell was talking about he's all ready to continue increasing rates at a steady pace, and markets didn't like that, so he had to reverse course, and we've been going up ever since. But there will be a point when money cannot fix the problem, and that is when the game is over. I'm sorry to have to say, that is when the game is over. So the gentleman says that all we can say is for certain now that S&P futures reached a massively important confluence area, and so has the larger market. Tops are only known in hindsight, and we are far from confirming anything here, but at least we know where we are relatively to several key trends. And for today, at least all of these trends have asserted themselves in the form of a resistance point. And if they prove meaningful, it may be game over for this liquidity-soaked bull run. So we'll have to see what happens with that. But I do, before I let you guys go this morning, want to bring up an idea that the Federal Reserve has proposed. I don't know if you heard about this. A new rule to let inflation run hot ahead of the next recession. So it says, as the Federal Reserve remains unable to stoke inflation because it refuses to measure it correctly and refuses to factor in asset price inflation, it has now considered launching a new rule that will let inflation run above its 2% target to make up for the lost inflation. Though the Fed's policies are to protect the big Wall Street banks and keep liquidity ample in the financial system, its policies have overwhelmingly created deflation through supporting zombie companies and blowing up financial bubbles. Zombie companies through what we just talked about at the beginning of this video, corporate debt. They're borrowing to keep afloat, and they're only able to do this because of the Fed. So it says to make up for this lost inflation, the Fed will temporarily increase the target range above 2%, also known as symmetric overinflation. So the Fed members have expressed concerns that reverting the federal funds rate to the zero lower bound will drive inflation expectations lower. A real risk of Japanification, quote unquote, something Albert Edwards is especially concerned about. Now, we're on our way. I mean, look at Germany. They're right there. They are dining with Japan right now. And guess what? The blue line, U.S., we're heading that way too. Is without a shadow of a doubt, there's no way interest rates can be bumped up in this type of environment. Article finishes up by saying the strategy clearly shows the Fed is making up policy as it goes ahead of the next recession, where monetary policy will be less effective than ever before. The silver lining, risk prices will be at an all-time high as the world careens towards the next global recession. There you have it. I just want to give you guys an update this morning on what's going on with policy, with, corporate debt. It's a major issue. It's a major issue. And I would have to say Forbes is probably right. 75% sounds more realistic than 45% of GDP. You guys let me know your thoughts on this situation. When does it end? Can the Fed continue this? Will they be able to kick the can? If so, how much longer? I feel sorry for Trump because you live by the numbers, you die by the numbers. And if he gets reelected, he's definitely dying by the numbers. There's no way we can hold this together another 4 years. It's just absolutely no way. And it's your boy Crypto Blood. If you found this video informative, make sure you like, share, and subscribe. And click that bell to receive notifications of videos like this. I'm out of here, people. Out.